Welcome to the Chase Hudson Show, a podcast dedicated to inspiring you to become extraordinary. Each week, we sit down with top-tier business owners, real estate investors, and influencers to inspire you to build your legacy. It's time to level up. Hey guys, welcome to another episode of the Chase Hudson Show. Today we have Cameron Gunter, who is the founder of Pay Companies, one of the fastest growing commercial real estate development and investment firms in the country. If you're a real estate person or want to learn more about real estate, this is a fantastic episode. We go into the weeds a little bit, but it's such a great story where Cam was able to get Pay off the ground, how he did his first deal, how he's structuring deals now, raising funds, and everything in between. So excited for you guys to hear this one. And with that, let's dive in. All right, guys, welcome to another episode of the Chase Hudson Show. Today we have Cameron Gunter, who founded Pay Companies in 2003, which is now one of the fastest growing commercial real estate development and investment firms in the country. Currently, Pay's robust $2.4 billion AUM includes assets in multifamily, single-family rental communities, student housing, office, mixed use, and hospitality. Pay Companies has ownership throughout 27 states and 2 Canadian provinces and employs more than 1,100 employees nationwide. So quite the impressive resume there, Cameron, and thank you for being here.
Yeah, so it grew.
Yeah, no kidding.
Overnight.
Yeah, I mean, well, so 20 years, you guys just hit your 20-year mark.
Yeah.
Congratulations.
It doesn't seem like it, but
yeah, that's a big feat.
It's 20.
That's amazing. Well, congratulations. The first thing I typically ask my guests, Cameron, is just to talk a little bit about your upbringing. So any, influences, whether it was parents or siblings or, childhood, teenagers that influenced you or molded you into who you are today.
So I grew up on a farm in Idaho, which is, I think, influenced me who I am and being hard work and being responsible. Between my grandfather and my father, my grandfather owned a dry farm, or they ran a dry farm where they don't irrigate. They base it on Mother Nature. And then my dad was actually just a farmhand for my uncle in a dairy farm. And so between the two farms, moving back and forth, working in both, it really taught us responsibility. We didn't have a choice. I guess we did have a choice, but there's consequences for those choices. Mm-hmm. But it was good. We learned hard work. We learned responsibility. We learned how to be honest. And so all those things have helped us. People don't realize what a farm is. It's a business. And you have to be creative to make things work. And so those values have really shaped who I am and what we're doing. And, growing up like that, you always have the desire to do something different. I enjoyed farming. I still enjoy it, but it's a hard way to make a living. And so, and most of my family are all grew up that way. And so education was not a huge push. And so I was one of the first in my family and even extended family to graduate from college. And I had a desire to be an accountant. I don't know why. And so I ended up graduating in accounting, and the rest is all experiences and history.
Yeah, got it. Tell us a little bit about your experience at college. So I also studied accounting and did not end up going that route, but yeah, what was it about accounting? And then maybe take us through kind of your early career. What did you do with that degree thereafter? Yeah,
so I did. I graduated in accounting. I went to a few different schools. I actually was able to go play football at junior college at Dixie.
Cool.
For a year, just because I was a Prop 48, which is I had to go to a junior college before I could go to a 4-year school or in the Division 1AA or Division 2 school. So did that for a year and then transferred to Southern Utah. And then at Southern Utah, I was there. I played for a season and a half and then got married, and life changes when you get married, and decided that time to buckle down, and we transferred to Idaho State, and I graduated from Idaho State in accounting and went to work for J.R. Simplot Company as a kind of internal auditor while I'm in my senior year. And after that, my wife's from down here in Utah County and wanted to come home. And so I ended up moving back here and working for a CPA firm. Lasted about 6 months because I guess I'm not a guy that likes to do the same thing over and over. It's a great degree to have, and I'll tell anybody, if you're going to do something in business, go get an accounting degree. But I ended up going to work for Lehigh City as a finance director when Micron came to town, helped structure that tax incentive deal, which was the second largest in the United States at the time.
Wow.
And just was from there, was in city management at Springville and then in Ivans, and left city management to go work for a general contractor doing business development. And mostly what I was doing for them is helping developers get through city entitlement, helping them a little bit with some of the financing and economic development, chasing different tenants. And so that really, with my accounting background, with my city background, and then working on the construction side and understanding commercial construction, it really launched me into starting PEG in basically 2003. So
yeah. How old were you at that time?
Let's see. What would I have been? 32.
32?
Yeah.
Okay. So you spent, call it a decade in accounting, city management, project management. Why did you decide at that time, hey, now's the time to start my own company?
I think it kind of fell into, from my experiences, what we were doing, it kind of fell into my lap that way. Not that was ever what I had dreamed of doing. Even though I like to see buildings being built, I love the creative side of it on the city side, where I was bringing different things into the city to help the cities grow. And so I saw the opportunity to go out, because I was doing some consulting for some other high net worth families. And it just seemed like, look, I think I can do this. I didn't have any wealth in my family at all. And so it was really just saying, okay, I've got relationships with some people that we've done stuff with. Can we go start something? Can we go make it work? And I saw the opportunity to me, it's to build buildings. And it's probably because growing up on a farm, we grew a crop every year and we harvested. And there's joy in seeing what you're doing, right? You plant the crop, you see it grow, you work it all summer long, and in the fall you harvest it. And so I always think back and go, I think some of what I'm doing now is that same stuff. It's just at a bigger scale and it takes longer for some of your crops to harvest. So
yeah,
I think subconsciously maybe that was it, but that and understanding how the cities worked and seeing the joy to redevelop something or see something neat come out of it and having growth in a community really excited.
Yeah.
It really excited me. So, and that's probably why we started it.
Yeah, I love it. So what did PEG look like when you decided to start it? Was it just you? And then did you have to, raise any capital to quit your job at Lehigh City and get it off the ground? What were the first little bit? How did that look like for you guys?
So I was working for the general contractor.
Okay, sorry,
It was Ellsworth Paulson Construction. And our first project was in Rexburg, Idaho. And so I had an opportunity with a family office at Idaho Falls that I was consulting with to go work for them and run the real estate group. But my wife wasn't fond of moving back to Idaho. Mm-hmm. And so as opposed to doing that, we started PEG with the guy that owned the construction company, Richard Ellsworth. So he and I were 50-50 partners. And really what he brought is some of the financial strength on the balance sheet, because of his company. And then what I brought are some of the relationships and some of the deals that we did. And one of them was this project in Rexburg, Idaho. It's called the Rex. It was the Rex, now it's Fat Cats. But we took an old tractor implement that was going out of business, and we took that property, which there was kind of a retail building up front where they had all their sales and some of their implement. and the back was where they had all the tractors. And we took that front building and converted it into a retail center that had Blockbuster Video, Desert Book. I mean, this was when Blockbuster Video existed. And then we built a couple pad sites. One was a Jack in the Box, and did a land lease with them. And then we did another 3-tenant pad building that had Bahios, if you remember when Bahios existed.
That was my first job as a teenager, working at Bahio.
Yeah, so we did a Bahios there. And on the back of it, because it didn't have frontage, we did what's now known as Fat Cats. But before that, it was a American Family Entertainment that we did. And so that really was our first big deal outside of consulting. And then that really kicked us off. We did a hotel in St. George with this family office out of Idaho. I did a big retail center in Helena, Montana. So we did that. And then I did a big deal downtown Salt Lake called Immigration Court. There was a broken deal. It was a very big deal. The partnership couldn't figure out how to make it work. And so just because of my experience with cities and understanding how to get through zoning and even incentives, we were able to leverage all that for us to build a company. And then in 2005, my partner, Richard Ellsworth, got called to be a mission president. And so he asked me to buy him out of the company. And so I bought him out. And so there for a couple of years, I was basically the only owner of it, which was a challenge.
Yeah.
We were growing. It was good, but it was a challenge. But then one of my investors, who's recently passed, a guy named Reed Halliday, who invested with us in a couple of deals, ended up coming in as a partner in the company in 2007. So
it's great. I want to touch on that first deal a little bit, because I think for people who are interested in starting a real estate company, that first deal is so important. As you mentioned, it helped you snowball kind of into the second, third, fourth subsequently. That maybe dive a little bit into that first deal, and you did already, but maybe from the cost side, how you structured it financially. Did you go get a loan? How did you raise the capital for it? And maybe some of the details would be interesting, I think, for us to hear.
Yeah, so we did kind of a syndicate debt. We went to a group out of Spokane that was the lead investor, but they'd used a line bank, which at the time was Bank of the West, so they were out of Spokane. They were a bank out of Spokane. And so they came together as a senior debt. And then that was back when we could leverage a little bit more than where we're at today. But we still didn't, even back then, we were only leveraging 75%. And so the 25% equity came from a little bit of I structured a deal with the landowner, kind of a buyout from the landowner. Either that, they were going to lose it to the bank. So we gave them cash, a little bit of cash. My original partner put money in, and then I went and raised a little bit of money from a couple other people that I knew, just from being in city management and helping them through when I was with the contractor. So we just raised a little bit of money on that deal, and then that kicked that off as our first deal going forward. But while we were doing that, it helped me, I think, more have the confidence that, look, I can make this work. We can go out and raise capital, which I'd never really done before like that. And because we had some fairly good opportunities, just because we could go into some projects that had tax incentives or favorable zoning. So I think that really gave me the confidence to go out and raise capital, because before that, I mean, all this was foreign to me. You don't raise capital go work on a dairy farm or raise crops.
Right. So what was the total cost of that project, and how much did you guys have to raise in equity from investors?
So I can't remember the exact amount of the project. It's somewhere in the $15 million range, and we raised somewhere around $3.5 to $4 million for it. That's a good
size. I mean, that's a good amount for your first deal, and being able to get that done. So I like to touch on that because it's so critical to when every deal gets easier. I mean, theoretically, as you learn to more raise more capital and execute. So I always kind of like to get the details.
Unless you go do what we did. We did that deal, which was 15, and then we jumped into this immigration court deal, which was downtown Salt Lake, 238 units, which was a $40 million deal. Now, the benefit we had there is we only had to come up with a little bit of capital. That's where I met Reed Halliday, because the deal made a lot of sense because it was distressed. So we recapped it, took it from a affordable housing project where they were trying to get tax credits, took it to a market rate, restructured the financing for it, restructured the equity side of it. And we were actually fortunate enough only to have to bring, $200,000 or $300,000 into that deal, where we then went and raised another $5 to $6 million on that. So, and my business partner also had relationships out there, and he would introduce us, and we'd go pitch the deal. So
yeah, got it. It's impressive. So your partner goes on an LDS mission. You buy him out. And again, diving into the weeds a little bit here, but were you able to just write a check from the bank of Cameron Gunter to buy him out, or did you have to go raise money to get him, to remove him from the partnership at that time?
So the way I bought him out was I gave him, we had enough deals that had created value. And so the way we separated, the way I bought him out is I gave him ownership, some of our carried interest and actual ownership in some projects, and I kept some projects.
Got it.
And so it was really no cash for me to buy him out.
Okay.
It was just our, opportunities and carried interest in some of the other projects that bought him out of it. So.
Makes sense. And for the first couple of years, were you, surviving off of development fees, off of, construction management fees? How were you, living day to day from the get-go? How did you charge fees, or how did you operate overhead?
Yeah, so we charge a development fee. We defer most of our development fee, but then we'd take some of it out as kind of operating costs, and that's what we'd pay. I think originally we had 3 of us in the office, and we grew it as we got more deals. And then I'd do some consulting. Deals with this family office in Idaho, where they'd pay me a fee to do their tax increment. I think I got them $15 million from the city of Idaho Falls, and I got a piece of that as a consulting fee, and I'd take that and I'd roll it into either paying our people or putting a little bit of money into another project and going through entitlement or tying up ground, and then taking out to investors to invest in it. So
yeah, makes sense. That's great. So you now have the reins on PEG 2005, 2006. What did the next several years look like as you began to scale?
Well, if the great financial crisis wouldn't have hit, we would have been much different. But as everybody knows, in 2008, as we were just getting going and things were happening, we had everything shut down, banks failures and all those things. So the benefit we had is we didn't over leverage anything. So we never lost an asset. We never had the bank take anything back. We had to come up with money to get it back into compliance by paying it down to a leverage ratio that the banks would do, and we were able to do that. But during that time too, I think in 2008, because I had to lay some people off. I think then we were like 9 people, and we shrunk back down to 6. And part of that, I kept paying them, but I didn't take a paycheck for probably 8 months, just so we could keep everybody there and keep going, because we saw opportunities, and opportunities did present themselves, and that's really what kicked us off, is we were able to take advantage in 2009, 2010, 2011 of continuing to build. When things started to free up again, we used HUD to build a couple of projects for us. That's when we did immigration, a phase 2 on immigration, actually. So we did a second phase on that project. And then we were able to buy some hotels at discounts from banks, like at 20 cents on the dollar, which was great for us. And then we ended up really building that hospitality portfolio at that time and growing that business a little bit, as well as finding opportunities to develop new multifamily projects. But we basically got out of all the retail stuff we were doing. So we don't do much retail anymore, and we've really stuck to multifamily and hospitality.
Makes sense. And speaking of your portfolio and strategy, you've been very diversified. It sounds like historically and today as well, between multi-hospitality, office, some single family, student housing. How have you been able to manage the diversification and maybe not getting overstretched with allocating your time and resources at different product types?
Part of it's bringing the right people in, and then having them focus on an area that they know. Part of it also is we probably in 2011, 2012, we brought in our own property management company for apartments, which helped us really understand and control our multifamily a little bit better and get us into opportunities. And so we had a better understanding, and we could control that investment a lot better and manage the investment. I don't necessarily say control it, but manage the investment better, which was good for us. And then over time, I think in 2014, we invested in a hotel management company that we bought the majority of them and had them start doing our own stuff. And then I think 2 years ago or 3 years ago, we bought the other side out or did a trade. So Peg owned all of it. So, I mean, that's been one of the things that's really helped us, I think.
Yeah. I got finished done reading What It Takes, which is Steve Schwartzman, the founder of Blackstone. And similar to you, when they first started, it was just consulting and then transitioning into private equity. But as they grew, it was really just hiring talent and, compensating them appropriately to build a vertical of the business or buying an existing, vertical that already exists. Sounds similar to what you've done, because as a group that's vertically integrated, and as a newer investment company like ourselves, it's something that we aspire to do. I think that's kind of the end goal. And there's different opinions. I think there's pros and cons to vertically integrating, where I've seen in some groups, if you have a property manager who's not doing a great job, there's a lot of politics that come into play when they're your employee versus just being able to go find some other property management group to take over. So just to dive a little bit more in there, how has vertical integration versus doing third-party property management or just doing third-party GC work or development work, how has that benefited, and what have you seen as the pros and cons to that?
It's interesting. I had the same conversation this week about how we can vertically integrate and if it's good or if it's bad. And there are challenges being vertically integrated, as you've said. And I think the key to that vertical integration is if we're all on the same page, we know what the goal in mind is, because what you're going to have when you're vertically integrated, you're going to have your property management company wants to do it certain ways, and they're going to want different things. And because they're part of the same company, they're going to push their agenda. And you got the investment team saying, no, we're here protecting the investors, and we can't spend that. And so the challenge has always been is getting them on the same page, understanding the same business plan, approving the annual business plan, which is part of the overall business plan, and having them motivated the same way, right? Having them compensated based on the overall strategy itself. So that's been our biggest challenge, is getting them on that same page, because as you said, even though they're all in the same company, they have different ways they want to do something. You got one that's heavily investor focused, and the other one's heavily resident, tenant, guest focused. And so if we can merge those together, and that's really the vision of PEG, is creating these three pillars of people in our organization. It's the team member, it's the investor, and it's our tenants, residents, guests, or our customer. And making sure they all have a similar experience and their experience is equally the same, which is sometimes hard because they have different things. The investor wants a good investment. The tenant or the guest, they want a good experience. They want the best they can for the least amount of money they spend. So trying to get those together. But our philosophy is, if we have a happy customer, a happy tenant, resident, or a guest, and we have a happy team member, and we'll ultimately get the happy investor. because it'll all work out and people want to live in our communities or come to our hotels. So it's been a challenge, but I think I hope we're there. And that's the benefit of vertical integration for us.
Yeah, makes a lot of sense. And so if I understand correctly, you have PEG Construction, which is effectively like a general contractor, right? You have PEG Property Management or Property Group, which is your property management arm. Do they do multi-hospitality? Do they manage all your assets?
PEG Property Group is our management company, and they do multifamily and office and industrial. We don't have a lot of office industrial, mostly multifamily.
Got it.
And then we have PEG Hospitality Group, which is only hotel management.
Okay, got it. And then PEG Capital Partners kind of sounds like the investment side of the group, and then development is the development side. I was going to ask development versus acquisition. So it sounds like when you started off, it was a couple redevelopment projects, mostly development projects. How have you thought about the decision to acquire versus develop over the years?
Yeah, as opportunities present themselves with, just before the pandemic, we were starting to buy hotels because we bought a bunch from Blackstone that were Residence Inns because we saw an opportunity that they were older properties. They were going to lose the brand, so Marriott wanted a new one to replace it because these were 25, 30 years old, and they were basically 8-plexes. And so that gave us a little bit of an opportunity to go in and start acquiring as a hotel and run as a hotel because our cap rates, what we were buying them for, were, 9.5, which a 9.5 cap rate back then, and I leveraged it, gave me like a 14% cash on cash.
Sure.
We did that in 18 and 19, so it was going well, and then pandemic hits. Hotels, we know what happens to hotels. Now, extended stays still did okay, and they made debt service, but there was no return on them. And so our intent was always to convert those to Class B multifamily units, taking the cap rate compression, going from a hotel to a multifamily. The margins on a multifamily property are usually around 60%. Hotels are around 40%. So we got that a little bit more margin. And so even though our revenues drop by going multifamily, between the cap rate compression and the higher margin, it made sense for us, and the value on the exit was much greater. And so that's really when the acquisition. We did some acquisitions on distressed hotels in the great financial crisis and apartment building, but not a lot because we saw the development opportunity, and that's what we started as. But over the last 5 years, we've shifted a lot to doing both.
Yeah. And what do you think about the next, few years here, development versus acquisition? What are your guys' thought process? And with interest rates, debt, how are you thinking about the next little bit?
So we will do more acquisition just because we've grown too. I only have so much capacity to be a guarantor because all of our construction loans require personal guarantees and a strong balance sheet. And I think development now are tough. There's still opportunities in it, and we'll still do it, but it's a lot tougher simply because of your cost of capital on the debt side and construction costs. They're just not coming down. We're seeing them stabilize a little bit, but I just don't know if we'll see hopefully we get caught up in rents to where we're at construction-wise, and it'll stabilize enough and flatten. But I just don't see construction costs coming down with labor, with the skilled labor costs in mechanical, electrical. It just I think it's where we're at, and so we have to look at acquisition, replacement cost, and some of those things. Hopefully, cap rates move up a little bit. We also see coming up over the next year some distress opportunities where people got into these newer projects, multifamily projects, and their construction debt keeps going up. They weren't projecting that, and they're going to have to get out because that construction debt's due, and I think it'll create some opportunities for acquisitions. Yeah,
I agree. It's been the run-up in interest rates has been incredibly detrimental to some of these floating rate, construction projects. And so, I agree. There's most likely some opportunities on the on the horizon. I did notice, Cameron, on your guys' website, you have a variety of board members, strategic board members. I think you mentioned Mr. Holiday was one of them. But how have you been able to strategically hire or place people into your company to help you scale? And I think I'm mostly asking that probably from a capital raising side or maybe consulting side, because it doesn't look like it's just you, right? You've bolted on and had help. So how has that been helpful? Have you thought about that?
Well, yeah, this is all new. When I started, it was all new to me, right? I didn't grow up in the business and I didn't have the expertise. So Reed was a great mentor for me early on. He did have real estate investment, but he was more of a wealth management company that he owned in Beverly Hills. But he was more of a sounding board, looking at it from a financial, helping me understand, look, here's how you do it, and building relationships. And so he was one of a great mentor for me to understand how to keep going, right? Because things get tough sometimes and you want to just give up. So he was great with that. Then Mark Bingham came on as a partner who had sold a couple of companies, and he was from Vernal, down to earth, just a hardworking guy that built something out of nothing. And so it was always fun to get kind of his perspective on building a company. But then as we started to grow and we grew past that, we get into the $1 billion of management, that's when we started looking at, okay, I need to bring, we're talking about board still, I need to look at more sophisticated board members in the space that we're in. And so we were able to build a relationship with a guy that sold a asset management company. He still was running it, but he was able to come on our board. His name is Jay Rollins. Had some very successful funds and sold to Walker Dunlop. So he's still a board member and provides great advice. And we actually use our board as a true board, to where, in the boardroom, sometimes things get tough. They're not just a rubber stamp, but we ask them to be hard on us and look at the way we do things and try to give us direction. The other board member was a guy that sold a technology company, but he understood how to grow a company and take it to the scalability of it, which is always a challenge, is to figure out how to scale when I'm knowing everything. When you're 8 to 10 people, I'm knowing everything that's going on, and I don't have to have that system or the process baked as well as it does when you scale. And so the next thing which you ask is the people, and that's the hardest thing we've probably done. I have a lot of the same people who've been with me for our executive team. Most of them have been with me for over 10 years. And so that's been very helpful. But that next level management, that's where we had to train a lot of them up and bring them up from either bring experienced people in or train them up from analysts to give them some leadership skills. And so that's probably been the biggest challenge for us, is getting those right people to take over some of the responsibilities without the experience like the rest of us had.
Yeah, makes sense. And for those board members, how are you structuring their involvement, their compensation or involvement? For me, I envision it's like, hey, if I'm bringing in this strategic board member who was a wealth manager, he has fantastic connections to family offices or capital or what have you. How does that person get excited about, sitting in the PEG development room or the boardroom and talking about a deal? And are they, and you can share what you can. Don't want to ask too much here, but is it part of the promoted interest of the fund? Is it a salary? How do they get involved or excited about helping out?
Yeah, so one of our board members is an investor with us.
Okay.
After he had his exit, and then we pay him all a stipend.
Got it.
For being on the board. And typically, I today actually had 2 calls with board members, our outside board members, because we got a board meeting coming up, and it's not just that, but I talk to them on a regular basis, and that's part of what they're compensated for. They have to attend a quarterly board meeting, and we use them so the guy that had the asset management company and he had to manage the funds, I have him kind of guide our chief investment officers on how to do things and help them with processes. And then on the other board member is more an operations guy, so I have him work a lot with our operating team on processes, procedures. And so it's more of they do consulting, but then they're also in a board meeting once a quarter and providing that guidance. And we compensate them right now just on a stipend.
On a stipend, smart.
So, but the one is an investor, so there's some
overlap there.
Desire. And then the other one will probably bring in his arrangement with his other employer is now it's where he can do some other stuff. And so he will be able to come in and we'll probably plug him into our next fund and have him be part of that.
Yeah, I love it. That's really smart. And on the employee side, so when you initially bought your partner out, it sounded like Cameron Gunter, you had 100% ownership of PEG. As you've grown, and just looking at website, it looks like, partner. You've got a couple of people. So how have you thought about bringing on partners, divvying up, the share of kind of the upside or promote or carried interest? How have you thought about that? Because every firm's different, right? Yeah. Some people are like, hey, this is just for the founders, and some are like, hey, everyone's getting a piece. But how have you thought about that? It's a delicate balance, and would just be interested to hear how you've thought about that.
Yeah, so I got a couple of different ways. So my CFO, our COO, Chief Operating Officer, was actually with me when I started the company. He was like employee number one. And so he's still with me today. And so over time, he's gotten some ownership. And it's grown, which I think is important. And then we have other team members, CIOs, others that have ownership in the company, the operating company itself. And that's grown over time. We've given them opportunities to buy in. And then on the carried interest side, outside of what the company owns, and we're a C corp, so they have stock in a C corp, and the corporation takes so much of the carried interest, and then we allocate some of the other carried interest out to management team, and those that are over the strategy, and so we've been able to give them carried interest to keep the key employees that are running the program and that are putting their neck on the line and really going out and motivated to create a good investment. So there's upside and there's carried interest. So they get part of that. And then we obviously got our bonuses and stuff. But that's what we've tried to do. Now, those that aren't in those positions where they have the authority and the responsibility, we're trying to create another program for them to have interest, but it's more of a shared interest in a kind of a pool. So we'll allocate a little bit of that, a GP, out of the company side for them to benefit from it. And it's basically a phantom plan that they get. It's a profits interest or it's still a GP carry, but it's owned by the company, and then they get allocated kind of as a phantom stock or phantom payout, a phantom bonus.
It's smart. Yeah. Sounds like you've got a great balance there and properly incentivizing people. And it's always just curious to hear that. So I appreciate you sharing the detail, Cameron. Talking about raising capital. So what is your strategy when you guys go out? When you think about, hey, it's a $50 million deal, we need to raise $20 million of equity. What does that typically look like? Family office, high net worth? Is it institutional JV partners? How have you been able to get deals done?
Yeah, so it's a combination depending on what strategy is. So we have some fund structures, which right now we have two open funds. We have one open fund and one we're looking at getting ready to launch probably by the end of the year. But then we have direct invests. A lot of our direct invests are family offices, high net worth individuals. Some institutions will come into the direct. We're starting to see more and more folks want direct invest and not go into a fund. And so we've tried to create our funds around more institutional type strategies. So build for rent, for example, it's something that a lot of institutions, even some families, will invest in a fund because of the way the size it is and having to move quickly on them. And then acquisitions on distress is always a much easier way to raise money so you can act quickly. But development deals we found is probably more direct. And so we see a lot of bigger family offices, and when they go into that, it's more long-term hold versus a fund has a finite life. They're closed-end funds. And so we look at the buckets of investors differently. Institutional type will typically go in funds, and then the family offices and high net worth individuals like direct.
Yeah, that makes sense, and that's what we've seen as well. When you guys think about raising capital, I guess, have you had certain strategies that have worked? Because for us as a newer group, what we've seen thus far is there's probably not there's not a secret to it. It seems like there's this interconnected network and kind of spider web effect of like if you can make the right relationships and hopefully perform on your deals, it word of mouth. So anyway, I don't know how you've seen it or what strategies you've practiced to raise capital.
There's a track record. There is building the trust, obviously, through relationships, and you got to have the relationships so they know you, they like you, and then they become able to trust you. And part of that's track record. And then the other thing is I think it's a sales process of just continually finding new prospects, hunting, farming. And some of our best investments have been repeat investments. And so that's where track record makes a big difference. That's your lowest hanging fruit. So I think it's like anything else. It's perseverance, it's relationships, and it's continuing to follow up and provide good returns and fair returns and being honest.
Yeah, I love it, and agree with that wholeheartedly. Well, what has been maybe a current project or past project, anything that has been your favorite to date? Like I love working on this deal, or something that's been exciting for you going on right now?
I love this question because I love the project we built. It took me a long time, about 8 years, to get it open. It was a project in St. George, Utah, right on St. George Boulevard and Main Street. It's called the Advenair and City View Apartments. Yeah. It's I love it. Still love it today. Love to go in it. It's a cool hotel. It's an autograph that we were able to, we call it urban chic, kind of after the founders of St. George. It has to do with the LDS Church too, because of the prophet that was sent down there, one of the general authorities that was sent down there to really create the community. It was Erastus Snow. So we designed the hotel around what we call the Erastus Snow Big House, where everybody to go down when they developed that community, the church would send their leaders down and they'd stay in Erastus Snow home, and it was acted like a hotel. So we kind of did a replica of that and did it more urban chic. So this kind of the cool stuff. And then we did the apartments around it. And so we created this kind of downtown living, eating concept in St. George right on the boulevard, which still today, it's one of my favorite projects. So there's a lot, but that's probably my favorite.
Yeah, sounds amazing.
And it's doing well.
Yeah, good. I bet it is. I love St. George, and hotel, especially a newer, nicer hotel. I mean, I'm sure that is just a great hit. So of the $2.4 billion AUM that PEG has right now, I'm curious, you mentioned direct deals fund. You have one fund. About how much equity would you say you guys have raised over the last 20 years to get to that number, and how much of that is fund versus direct?
Yeah, so fund-wise, we've probably, between, when I say fund, we also do a co-invest in our fund, so I'll clump those together. So we're probably, in 4 funds that we probably have, I'd say, $700 million of equity in those 4 funds. Wow. And once we close the other one, we'll be closer to, or once we close Fund 4, we'll be closer to $1 billion in equity raised through funds. And so probably $1.3 billion was raised outside of that, or $1.4 billion or so.
Right. That's amazing. So those funds, you said, are they typically open-ended funds, or
they're
they closed? They're closed-ended. Okay, closed-ended. So then your average fund has been, 150 to 300 million-ish. Mm-hmm. Wow. And to be able to raise that from family offices and high net worth predominantly, that's really impressive, Cameron. Yeah. Because
it was hard.
So what's your average check size then coming into your fund?
we're over $1 million just because we have some bigger ones in them.
Yeah.
Our first fund was probably a lot less from the fund. The fund itself, Fund 1, was probably only $70 million in the fund, but there was a co-invest sidecar of about that same amount, and then a JV of, I guess the sidecar was probably $50 million, and then a JV of probably another 50.
Wow.
So we always do a co-invest side. Well, we did early. I don't know how often we'll do it now, but there's always a co-invest sidecar in our prior funds. So
yeah, it's amazing.
So I think our first fund, in the fund itself, we were probably average size of just under $1 million.
Yeah, wow. And
So
when did
growing.
you raise the first fund? What year was that?
In 2018.
2000. Okay, so these are relatively newer strategies. So up to that point, it was direct deal only, pretty much.
All direct.
But now it sounds like you're still balancing fund versus direct deal, depending on it. So when you tie up a piece of land or a deal, right now, is that just, hey, you're funding that from your fund?
It depends on the strategy. So it's very clear strategy. So we don't have just a big fund. So the build for rent fund, only investing in build for rent communities. And so if I had a opportunity to do a build for rent community, it has to go into the fund.
Right.
I can't do a direct raise for it. All hospitality stuff I can do direct. And then our extended stay conversion fund, which was Fund 3, while it was open, I could only put extended stay conversions in that fund. So I couldn't go do a separate deal with somebody else.
Sure.
We had to leave it. Now that's closed, we could go out and do a direct raise on extended stay conversions. But that's what we're looking at in our Fund 5. Do we put it in there?
Yeah.
Because we had so much interest in that as a fund.
So they've been pretty specialized, the funds, single family conversion fund. So it's not like, hey, the PEG Fund 5, just anything goes. Okay. Mm-hmm. Yeah, that's
similar to, I guess it's going to be similar to what Bridge has certain buckets of their funds as well.
Affordable housing fund, exactly. Yeah, that makes perfect sense. Well, we'll wrap up here in just a bit, just transitioning away kind of from PEG itself. We're talking about money, so you've obviously had a lot of success, Cameron, in your life, and as you guys have scaled. I'm curious, and I like to ask this question. Just a lot of entrepreneurs, the end game, maybe not the end game, but a big part of it is the monetary. When can I feel like I've made it or have enough or what have you? But how has your perspective on money changed as you've had success? How do you view money? How is it? How does it impact your life?
Money doesn't drive me. I grew up with not a lot of money. We were low income, didn't have a lot, and wasn't poor by any means, just because we were raised on a farm and we had plenty of food. Now it wasn't going out to eat or any of those things, and we worked and we got money and we bought our clothes. I remember, I think early on in my life, my mom made our clothes, and we were so embarrassed and we'd tell our mom that we don't want to wear that shirt, we don't want to wear those pants. So she got creative and she went and got old rags and found the tag. Maybe it said Fruit of the Looms or whatever it was, and she would sew the tag on the back of our shirt. Or she'd do a design on our jeans so it looked like they were not homemade. So
that's a good mom.
So it's, for me, I always sometimes worry that, gosh, I'm cautious to go out and buy a lot, right? And so I just had this discussion with my wife the other day. We just built a brand new office, a nice office, and she's saying, we've lived in this house and we live modestly in a home. She said, I've lived in this house for 18 years. This is my office, and it still hasn't been remodeled. It looks the same, and you got a brand new office. It's my turn. So, it's just, I think I always say money doesn't change you. It gives you better opportunities to be more impactful. So, I keep a lot of money in the company to grow it and to give other people opportunities, and that's the excitement. For me, and just see that grow. But there's got to be a time. My wife keeps reminding me is, look, we've got to start doing stuff, for our family, our kids, which we do. That's important for us, is to we have 5 kids, they've got grandkids, and we always do trips. We do 2 trips a year. We want to pay for them. I've got daughters that are school teachers, which is great because we need good school teachers, but sometimes they don't have the ability to afford big trips, and keeps our family close. We go to the lake all the time, and so for us, it doesn't drive me. It doesn't really make me motivated as much to go out and do something different. What motivates me is the opportunity to give other people that the ability to progress and have the experience. And so as it comes, money comes, and you manage it, you reinvest it. I mean, there will be a time that we're going to have to, or that we'll want to start taking money out of the company and looking at different things, because we've lived a very modest life, I guess, and I think it's benefited. We've built a legacy company. I want to continue to do that.
Yeah, I love it. Great insight and advice, Cameron. What's next for you? What does the next 5-10 years look like for you and for PEG?
Hopefully, we continue to grow. We get better procedures. We're able to scale. We're able to give other people opportunities, and we're able to continue to grow an investment structure that people want to continue to invest in, and we can fine tune this vision of ours of having a vertically integrated company. The vision of our company is building trust, reimagining communities, and broadening horizons everywhere. And I truly believe that as a company, to be successful and to have that legacy company, we have to execute on that. And it's those 3 pillars that'll get us to that execution of a legacy company.
Yeah, I love it. Well, last question is just any advice that you'd give for, a budding entrepreneur, somebody looking to start their own company. I know it's a very generic question, but anything that you might share to help somebody out.
Yeah, if I were to tell myself what to do early on, is be prepared to scale. Trying to scale, I think our COO said it this way. He said, we're driving down the road at 75 miles an hour, and we're trying to change a flat tire as we're going. And that's probably the toughest thing. I mean, you can't do it. It's just very tough. And so the thing I would tell myself or tell anybody else, which I learned it, everybody learns it in school, is to scale, you have to have processes and systems. And our failure, I think, and what made it more complicated for us and more challenging is we understood, I think I understood it, but I didn't implement it the way it should. And so if I were to tell anybody, be careful what you wish for, because it could happen, but be prepared for what you wish for. And that is figure out your processes and procedures that work, put systems in place, so when you do grow, that your people know how to communicate, and there's a system that forces you to communicate. Instead of, like when we were 10 people, I knew everything was going on. When we're 145 in the office and 1,100 throughout the country, it's tough. You've got to have other people with the same systems and processes that we had when we started the company to start the success.
That's great advice, and no better way to end. I was saying before we started recording, Cameron, for somebody who works in real estate, PEG is a household name, very well respected. And so, again, I want to thank you for taking the time to come and share your story with us, and excited for your guys' continued growth and presence in the market and beyond. So thank you again.
Thank you for having me. It was fun to talk about.
Awesome. Thanks, Cameron. Thanks for listening to The Chase Hudson Show. If you liked what you heard, please leave me a review and subscribe to this podcast. Reviews really help us to find better guests and to improve the overall quality of the show. If you'd like to connect with me directly or want to learn more about investing in real estate, send me a DM on Instagram at @officialchasehudson. Again, we really appreciate you listening, and we'll talk to you on the next episode.